Alright, welcome to my continuing analysis of Sunnova's second set of books, which I got my hands on because someone at Sunnova really screwed up an Excel file. Now, just as a heads up, the first 15-ish minutes of this video will have very few visuals, because I have to walk you through some key concepts before I walk you through Sunnova's numbers. Illustrating concepts on YouTube is usually the sort of thing you'd hire an animator to do, but the knowledge of the second set of books was kept within a very tight circle of people before it was made public through this video series, and none of those people know how to make animations. So thanks to that, you're going to be looking at PowerPoint slides for the first 15 minutes of the video or so. And once I wrap that up, I can start going over the numbers in Sunnova's second set of books. That'll sort of be part 2 of this video, and trust me, I will have an awful lot to show you there. Now, in the last video, I showed you how Sunnova's customers are being systemically misreported. Systems are customers, customers are systems, but neither is supposed to be neither, and as a result, Sunnova appears to be misreporting customers that don't even exist in the first place, and there's written instructions to do this. It's a mess. Now, in this video, I'm going to explain my understanding of a quirk in how the financing of these residential solar companies makes them uniquely susceptible to turning into a very particular type of accounting scheme that is all but mathematically guaranteed to collapse. Now, when I walk you through how that accounting scheme that's all but mathematically guaranteed to collapse would work, I know a lot of people will say, hey, isn't that just a Ponzi scheme? So I wanted to preempt that with a quick disclaimer here. Ponzi schemes have a specific legal definition, and I am not a legal expert. Therefore, I do not have the tools nor expertise necessary to determine if something is or is not a Ponzi scheme. I will refrain from any speculation or commentary on what does or does not qualify as a Ponzi scheme in this video, or which company or persons may or may not be running a Ponzi scheme. Also, everything in this video is in my own personal opinion, based on my own analysis, and if Sunnova doesn't want me commenting publicly on their second set of books, the appropriate legal remedy is for them not to have screwed up and given them to me in the first place. Anyways, that's the end of the intro and all the various legal disclaimers I had to give, so let's get to the video. Okay, so first things first, if you're just a number cruncher, one really key detail that might never really click with you is how absolutely critical operations and maintenance expenses are to a residential solar company's finances. If you need your home solar system to be cleaned, inspected, or repaired, then the residential solar company has to gather a small group of guys, usually 2, pile them into a truck, have them drive miles across town, and then have them put on safety gear so they can climb up on your frickin' roof. And that's before they actually start to work on the system, which is the whole point of this endeavor. Obviously, this is going to be an absurdly expensive way to maintain a solar system, and in fact, O&M is the biggest expense by far on a residential solar system, with the exception of the solar system itself. So if a residential solar company misreported how much it was spending on O&M, that would be like if an airline misreported how much it was spending on fuel for its airplanes. If they got away with misreporting a number that important, then in principle, it would be possible to seriously distort the rest of the company's finances and still have it come out looking right. I'll get into the details of why in a few minutes, but one thing you have to remember throughout this video is that residential solar companies are essentially not allowed to make a loss on O&M. I want to be crystal clear here. I'm not saying that a residential solar company isn't allowed to cover up an O&M loss from investors. I'm saying they're not allowed to make the loss at all in the first place. That in and of itself is a problem. If they then also hide the loss from investors, that is an additional problem. The reason why is that due to its financing, a residential solar company cannot make a loss on O&M without committing some kind of fraud. And just to be clear, that wouldn't be fraud according to me, that would be fraud according to Sunnova itself. In 2022, an associate of mine recorded Sunnova's then CFO Robert Lane admitting this on tape. Now, at the beginning of this video series, I said I would show Robert Lane's full answer and the question he was asked. However, while I can play Robert Lane's full unedited answer, which is the important part, I have since been advised by counsel that I am not allowed to share the voice of the person who asked the question because that individual enjoys certain legal protections. I can share the question itself, no problem. I just can't play the voice of the person who asked the question. So here's the question, written down verbatim exactly as it was asked, word for word. And just to provide a little bit of context here, this question was asked about 2 weeks after Muddy Waters, which is a prominent short-selling firm run by a guy named Carson Block, put out a report that essentially accused Sunrun, which is Sunnova's main competitor, of underbilling O&M as part of a tax fraud scheme. And this question is basically asking, how do we know that Sunnova is not doing the same thing that Sunrun was just accused of doing? And here is Robert Lane's full answer.
Yeah, so we do keep records of what we spend on O&M and what comes in on the O&M fees. So that's available if we get audited, and we keep them because in case we get audited. to show that we are not generating a loss. I mean, we cannot generate a loss at O&M, and because then that would be fraud.
Okay, so why would making a loss on O&M be such a huge problem? Good question. A key part of the residential solar industry is that solar systems are eligible for a federal tax credit, and the operations and maintenance expenses are far more closely linked to these tax credits than they would appear to be at first glance to most people. So if a solar system goes on a roof, someone somewhere is going to get a tax credit, but the residential solar company will virtually always wind up with the money from the tax credit, if not the tax credit itself. The lease and PPA systems are owned by the solar company, so they get the tax credits in those directly. Now, if a customer uses a loan-to-buy system, the customer is the one who gets the tax credit. But there's typically a clause in the contract that says they have to remit the value of that tax credit back to the residential solar company. Assuming, of course, they get the loan through the installer, which is basically always the case anyways. So the solar company still winds up with the money. The connection between O&M and the tax credit comes from the residential solar companies using an income approach to value their solar systems. The income approach is the one that involves you feeding a million numbers into a computer to estimate the fair market value, or FMV, which is what fair market value stands for, of the solar system. Now, this is pretty stupid because solar systems are regularly bought and sold for cash. The fair market value of something is defined as, quote, the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell and both having reasonable knowledge of the relevant facts, unquote. The income approach is essentially used to hypothesize what the fair market value would be if there was a fair market when there isn't. Like if you're buying a super niche product or a one-off piece of machinery, something like that, then there might not actually be a market for that particular item, so therefore there is no fair market for it, but you still might need to come up with a fair market value for that item for accounting and or tax purposes. But if we do actually have a fair market where, say, solar systems are bought and sold regularly for cash, then we don't need to hypothesize or guess or estimate what the fair market value is because we already have an answer. There's a fair market for solar systems. The solar systems have a value in that fair market. That is their fair market value. This is about as self-explanatory as things can get. So the IRS should laugh these companies out of the room when they try to use the income approach to estimate the FMV of their solar systems when we already know what the FMV of their solar systems is. However, the IRS lets them do it anyways. So these companies are just allowed to feed a million little poorly understood and hard to check variables into a computer to estimate how many tax credits they're de facto allowed to sell for cash, even though there is a simple and objective measurement for that already available. And this means that, hypothetically, if one of those companies simply decided to lie for money, which no company has ever done in history, it would be extremely easy for them to do it and extremely hard to catch them. There's no good reason to let any company use the income approach when you don't have to. It's very irresponsible. You're just asking for trouble at that point. Out of all of those million numbers that get fed into the computer to come up with the FMV under the income approach, the O&M is one of the most important because it's the main expense. Because of this, assumptions about O&M have a massive effect on the fair market value of the system, and the FMV is what you take the tax credit on. So if a residential solar company underreported O&M, they would get a bigger tax credit. However, as you'll see as this video goes along, underreporting O&M has massive side effects. So let's put a pause on the O&M stuff briefly and come back to it in a few minutes, because there's one other thing that really doesn't click with most people when they look at residential solar companies, and the O&M winds up looping back into this problem as well. The IRS practices exceptionally lax oversight of residential solar companies when they claim tax credits, and I mean exceptionally lax oversight. It's kind of an open secret that many residential solar companies are less than entirely honest with the IRS, and a lot of the financial analysis around the residential solar industry basically focuses on whether or not the IRS is going to actually start enforcing the rules. Those analysts and the IRS agents that are kind of ignoring this problem are missing one really crucial realization. Okay, let's take a simple, straightforward example everyone will be familiar with. If someone mugs you and takes your money, and that guy who mugged you is not caught, then he gets away with it. It's a very straightforward concept. If you steal money and get away with it, then you just have the money, end of story. In the same vein, if a homeowner buys a solar system for cash and then lies to the IRS about how much that solar system is worth in order to get a bigger tax credit, and then the IRS doesn't catch them doing this, then the homeowner just has the money, end of story. Now, most people assume that if a residential solar company misvalues its solar systems for tax purposes, it would work just like that. They do something they're not supposed to do, and they don't get caught, and then they just have the money, end of story. And people make that assumption because that's how this stuff always works. That's how it has to work, right? But that assumption would be wrong. That's not how this would work if it involved a residential solar company, and the reason why is the financing. That's what's gonna blindside people. Residential solar companies typically do not generate a profit. They can't use their tax credits normally if they don't have taxable income. The solution to this problem is a partnership flip transaction. In the most absolute basic terms, a partnership flip transaction does two things. First, it securitizes the solar systems so the residential solar companies can sell them off to get the money to go install more systems. Second, it lets you sell the solar systems and the tax credits on the solar systems to different people. I try not to overload you with terminology, but these two terms will be very easy to remember. The tax equity investor is buying the tax benefits, and the sponsor equity investor is buying everything that isn't the tax credits. They're essentially buying the rights to all of the other money the solar systems generate, which is very similar to buying the solar systems themselves, but it's actually not quite the same thing. Quick side note, when you're dealing with securitizations, there's often a difference between how things practically work and how they're legally structured. My favorite example is that, legally speaking, the residential solar companies don't sell tax credits, they merely provide tax credits to other companies in exchange for money. Legally speaking, that is not a sale. Practically speaking, that is a sale. As you can see, this is a perfect recipe to create a mountain of asinine semantics. So in this video, please assume that when I'm talking about securitizations, my words are describing how the securitizations practically work, not how they are legally structured. Now, with that side note out of the way, let's get back to the main story here. The reason overvaluing the solar system for tax purposes is a massive problem is because sponsor equity is a bigger portion of the deal than the tax equity. Now, if you're wondering, why on earth would that be a problem? Well, let me walk you through an example. The exact numbers have gone up and down at different points in time, but most of the time, solar systems have been eligible for a 30% tax credit. So let's use the plain old garden variety 30% tax credit as our example. In this scenario, the tax equity investor would buy the 30% tax credit plus a few other smaller tax benefits, such as the depreciation on the systems. This other stuff is worth a little bit of money on top of the 30%, so this means that the tax equity winds up being about 38% of the overall deal, and the sponsor equity is the other 62%. Now, because the 38% is mostly based on a 30% tax credit, which is written into the law, there isn't a whole lot of wiggle room there. So investors know that tax equity has to be about 38%. However, let's round the 38-62 split off to a 40-60 split moving forward, just to keep the numbers nice and round. Let's say you have $100 million worth of solar systems. You will have $40 million worth of tax equity and $60 million worth of sponsor equity. Now, let's say you lie to the IRS and get more tax credits than you're supposed to, and these are enough to inflate the tax equity by 50%. That will inflate the apparent value of your tax equity from $40 million to $60 million. The problem here is you no longer have a 40-60 split. You're claiming to have $60 million in tax equity and $60 million in sponsor equity. You have a 60-60 split, or I guess I should say a 50-50 split. That would mean that you would effectively be claiming that your tax equity is half of the deal, but tax equity can't be half of the deal. Tax equity has to be about 40% of the deal because it's mostly based on a 30% tax credit, which is written into the law. And for good measure, most of the remaining 10% of the value is based on the depreciation, and that's also written into the law. So it will be blatantly obvious to any investor that looks at this that your securitization is fraudulent in some way, and no one will touch it. It's toxic. So the problem here isn't that the IRS will catch you. The problem is that you can't sell your security and get cashed out. So if you inflate the tax equity by overclaiming your tax credits, you then have to go inflate the sponsor equity enough so your securitization still looks like it has the 40-60 split investors are expecting to see. The problem is that it's a 40-60 split. If you have $40 million in tax equity and $60 million in sponsor equity, you have to inflate sponsor equity by $30 million to keep the 40-60 split. In other words, every dollar you inflate tax equity by, you somehow have to inflate sponsor equity by $1.50. That means every time a residential solar company overclaims $1 worth of tax credits, they need to somehow convince the sponsor equity investor that there is $1.50 in value that does not exist. Now, to be clear, just because you inflate sponsor equity by $1.50, that doesn't actually mean the sponsor equity investor pays you an extra $1.50 when he goes to buy it. Some people will understand why this is right off the bat, some won't, but explaining it will be a bit of a tangent, so I put that tangent at the end of this video, so it doesn't break the flow. Now, you can't just paper over this by sending the sponsor equity investors made up numbers, because they're buying the actual cash flows from the actual solar systems. That means they're expecting actual money to appear, and they're gonna know something's up if their money does not actually appear here. So you somehow need to convince them that there will be cash flows coming in the future that are worth $1.50 today. So if you're thinking you could just take the dollar and then invest it, earn some interest to pay the sponsor guys back, no, we're talking about present value, so interest and everything's already been factored in. You see the problem here. You got $1 from cheating the IRS, but then you have to promise the sponsor equity guy something worth $1.50 to cover that up. And they're gonna know you did this if you don't then actually pay them. You're 50 cents short. That's why this is an accounting scheme that is all but mathematically guaranteed to collapse. This relies on stringing an increasingly large number of investors along to pay back the ones that you've already scammed. So this begs the question, if a residential solar company was doing this, how would we know? Well, once the systems are securitized and sold, the residential solar company is paid to stick around and continue performing operations and maintenance on the systems, just like they were before they sold them. Like, the investors aren't going to roll trucks around and fix the systems themselves. They're going to pay someone to do that. The residential solar company was already doing that, so it just makes sense to pay them to stick around and keep doing it. And, you know, it would be really easy for the residential solar company to perform $2.50 worth of O&M and then only bill the investors for $1. There's the $1.50 the sponsor equity investors were expecting to see. Now, this kind of scheme will collapse if it doesn't grow and rope in an increasingly large number of investors. So while O&M is logically the first thing one would manipulate because it's just so easy to do it, O&M is also such a big expense that a company pulling this sort of scheme would eventually be mathematically required to underbill O&M in order to get away with it, because the scheme will grow until it's so big you have to do that. And to be pretty blunt, the kick to the nuts here is that the O&M is also used to value the system for tax purposes in the first place, hence the O&M death spiral. Underbilling O&M causes tax credits to be overclaimed, which causes the accounting scheme, which must be covered up by underbilling O&M, which causes tax credits to be overclaimed, which causes the accounting scheme, and around, and around, and around, and around you go. As you can see, underbilling O&M is both the cause and the cover-up. That's why it's such a big deal. Now remember, the residential solar companies have sold their solar systems off to investors. They're no longer their solar systems, they belong to someone else, and they're supposedly only being hired to stick around to maintain the solar systems. I cannot think of an honest reason on earth why anyone would ever agree to perform the maintenance for less than it costs them to perform the maintenance. Like, why would you pay someone to let you work for them? That's the opposite of how a job works. So, if a residential solar company was making a massive loss on O&M, it would be a very clear indication that they were running this kind of accounting scheme. Personally, I could not imagine a realistic scenario where they would be making a huge loss on O&M and would not be running this kind of accounting scheme. So, when I got my hands on Sunnova's second set of books, I figured out how to read them, figured out what they were doing with their customer numbers. After I put all of that together, the first thing I did was go and check Sunnova's O&M. Let me show you what I found. Alright, so let's break out Sunnova's 2023 10K, and we'll start to see the problems. So first things first, Sunnova claims at face value that its O&M per system went from $178 in 2022 to $251 in 2023. Now, that is not the industry standard way of reporting O&M. It's usually expressed in terms of O&M per kilowatt, not O&M per system, but that's that's going to be the least of the problems here. Still, seeing O&M reported in a strange way was, in my opinion, a red flag right off the bat. Whatever the case though, we now have a starting point for how much it costs Sunnova to perform the O&M. And remember, if all was well, if there was no problem here, whatever it cost them to perform the O&M should be just about the same as whatever they're getting paid to actually do the O&M. It also would not be a problem if the amount they're being paid to perform the O&M was higher than what it cost them to do the O&M, but it's not like solar system O&M is a particularly high margin business, so it'd still be pretty close. So that means the next thing we need to know is how much is Sunnova actually getting paid to perform the O&M? And to get that number, we're going to crack open the pre-sale reports. These pre-sale reports are from Kroll, which is a rating agency, and the pre-sales describe a security that is for sale. And what is described here will either basically or literally be identical to the security that actually is sold. It should be extremely similar, if not identical. These pre-sales are typically paywalled, so most people can't access them directly, but I'll show you the relevant parts. So this here is the 2021-1 pre-sale report, and if we go down to page, here we go. If we go to page 14, we can see that under an A- stress scenario, it assumes that O&M would be $27 per kilowatt for systems without storage and $33 per kilowatt for systems with storage. And as you can see up here, this is a 15% premium of the base case, which is what Sunnova would be getting paid from the securitization. Now, if we break out the 2024-2 presale and go down to page 17, we can see that under a Class A rating scenario, the assumption was $29 per kilowatt for systems without storage and $35 per kilowatt for systems with storage, which is what KBRA believes are needed to attract a new O&M provider in a distressed scenario. So those numbers haven't really changed much since 2021. It's still pretty similar. They're in the same ballpark. Now, the pre-sale reports give their O&M estimates in per watt terms, or per kilowatt terms, as I should say, while the financials just gives it in per system terms. Now, converting from a per system to a per watt metric is going to be a bit tricky because, as I explained in a previous video, Sunnova appears to be systemically misreporting its customer and system counts, and as I will explain in a future video, it appears as though the megawatt deployed figures are being misreported as well. So all of these irregularities makes it a bit tricky to figure out what Sunnova means by, well, literally any of this stuff. In addition, the customers in the pre-sales are not guaranteed to have identical O&M expenses to the customers that Sunnova has as a whole, but they should be pretty close. Anyways, if you take Sunnova's plain English reported O&M per system, like this number right here and this number right here, and just divide it by the reported average system size or any reasonable estimate for what their average system size is, or you take the average system size in the pre-sales and multiply those by the O&M per watt, then it's pretty obvious that the O&M per system that Sunnova's reporting their financials is more or less is what they're getting from the SPV. It's in the right ballpark, and that'll be more than good enough to highlight the issue because once we finish untying this Gordian knot, the reported O&M per system and what the hidden data implies is the actual O&M per solar system will be two extremely different numbers. Now, Sunnova's annual reports do admit that their O&M per system number has been, let's say, massaged in three ways. The first two are that they exclude net natural disaster costs and non-cash inventory and other impairments. Which, personally, this doesn't really make any sense to me. I mean, like, why would you care if your solar system was broken by a hurricane instead of a thunderstorm? It's your job to fix it either way. Technically, I'm not actually sure if a thunderstorm would count as a natural disaster under this definition, but if it did count, then excluding it would make even less sense, because that would be like a regular, normal, everyday natural disaster. But what I am sure about is that this is the net natural disaster losses. These are the losses that insurance didn't pay for. So it is entirely Sunnova's financial responsibility to fix them. So as far as I can tell, there is absolutely no reason that whatever Sunnova defines as net natural disaster losses should not be factored into the price Sunnova charges to perform operations and maintenance. And the third issue is if we scroll up to page 75 and read this definition, we can see that O&M does not include the payroll costs for O&M. Now, it's important to remember that Sunnova has had a legal obligation to pay its workers since 1865 when the 13th Amendment outlawed slavery. So clearly these expenses should be included in O&M directly, and the fact that they're not is, in my opinion, a pretty questionable accounting practice. Now, if you go on a bit of an Easter egg hunt through Sunnova's annual reports, you can pull all of these variables out for all of the years, and I went ahead and did that. It would take forever to show on video, but you can find all of these. And we can start seeing how this stacks up to the hidden data. So what Sunnova is essentially claiming is that if you take their total operations and maintenance expenses and subtract non-cash inventory and other impairments and natural disaster losses, and then divide that number by their weighted average number of systems, you should get their claimed O&M per system for that year. As you can see, the numbers do not match. So if you take what Sunnova said literally, these numbers will not add up. Yeah, no, it's off by like 100%, more than 100% in 2023, for example. So what gives? Well, we know there are a lot of irregularities involving the weighted average number of systems. So what if we instead turn this around and we have the supposed answer and all of the variables, instead of solving for the claimed O&M per system, let's turn around and solve for the weighted average number of systems and see how many they're using, and then go back to the hidden data and see if we can match that to the individual subcategories we now have for that data. So you remember from a previous video when we went through this data and turned the customer counts into weighted averages to prove they were the same as the system counts, which are originally calculated as weighted averages. So the thing we did to the customer numbers there, we're just gonna do that again here, but a lot more of it. This formula, what you do is you copy all of the data from here all the way back to the fourth quarter of 2018, because you need the last quarter of 2018 to make the averages work for 2019. I copied it all down here, then I set the averages for each quarter, then I went and calculated the averages for each year. And then I brought that back up here, and we can see if these totals add up to anything in any of these categories that we now see in the hidden data. Now, You normally would not be able to see weighted average number of customers/systems this detailed, but thanks to hidden data and basic estimates, we can. Seriously, that was quite the Excel script. Whoever forgot to disable copy and paste in that file, I mean, wow. As you can see, it's a very close, if you add up lease storage PPA and easy PPA in 2019, 2020, and 2023, they're almost an exact match. However, there's a big difference in 2021, 2022. However, if you add on service customers as well, it's an extremely close match in both years. Remember, if you do something very strange with weighted average number of systems, you could have a bit of a difference. So the reason it's off by a few thousand, rather than only 1 or 2,000 in 2021, is because Sunnova added 35,000 or so service customers all at once, because the customers they acquired in the SunStreet acquisition were counted as service customers. If those customers weren't added in the exact middle of the quarter, it would cause a slight offset in the averages. And since they added a huge number of service customers all at once, that's entirely plausible, if not probable. So what this data clearly indicates is that when Sunnova is calculating its O&M, the denominator it's using is consistently equal to the lease storage, the PPA, and the easy PPA, except in 2021 and 2022 when they were just stuffing the denominator with service customers. And stuffing the denominator pulls down the overall average. And I'm calling it stuffing the denominator because I can't think of a reason why it would be appropriate to include the service customers in the denominator. And in 2023, Sunnova stopped including them in the denominator, and I mean, if it was appropriate to include them, why would Sunnova ever take them out? So my conclusion is that they were being used to stuff the denominator. And the removal of these service customers from the denominator appears to be why the O&M per system increased so dramatically in 2023. Sunnova said in its 10K that it was because of higher truck roll costs and property insurance, but my analysis shows that it's mostly because they took the service customers out of the denominator. This also indicates that the costs associated with service customers were never in the numerator, which further indicates that that was just being stuffed. Now, the next issue is that Sunnova is responsible for the O&M on many, if not most, of its loan customers. It's just a quirk of how they do loans. Probably an intentional quirk, but I'll leave speculation aside. The loan customers aren't in the denominator for the O&M calculations. They never have been. This would imply that the O&M expenses associated with loan customers aren't in the numerator either. That's what it would imply. So where are the O&M expenses for Sunnova's supposed 100,000 solar loan customers? I have no idea, but I'm pretty sure they're not here. Moving on, the denominator is also getting stuffed with these lease storage battery customers. Now, this is interesting because they're counted on a one-to-one basis with the customers that do actually have solar systems. So batteries are not free to maintain, but they do cost far less to maintain than a solar system. Remember, batteries are inside the house, they're not exposed to the elements, so they break less often, and they're easier to fix when they do because you don't have to climb up on the roof to do it. You just walk in the house and fix it. So when Sunnova reports O&M per system here, that's not the same thing as O&M per solar system, and personally, I find that to be extremely misleading. O&M per solar system would be higher because the denominator is getting stuffed with these batteries. However, there's another way to take this. If you remember, Sunnova's own battery attachment and penetration rates clearly show that these two categories, lease storage and loan storage, have batteries. Whatever else they have, be it a solar system or nothing at all, it is very clear that they have a battery. Now remember, batteries and solar systems both count as systems in Sunnova's definitions. So if lease storage customers had a battery and a solar system, they would actually need to be counted as two systems in the denominator, but they're only counted as one here. The O&M thus implies that lease storage customers only have one system. We already know they have a battery, and we know that a battery counts as a system in this context. Therefore, they must be battery-only customers, which is another reason to believe that batteries are being inappropriately recorded as additional customers in the hidden data where investors can't see it, and then Sunnova uses plugs to move them around where they are ultimately misreported as additional solar customers. Amusingly, this also means that, as far as I can tell, Sunnova cannot possibly claim they calculated their O&M per system accurately without simultaneously admitting that a bunch of their reported solar customers do not actually have solar systems and are also not actually customers at all. That's a pretty nasty logical contradiction to have to explain to investors, and that's only one of many very big discrepancies with their O&M. And it's also yet one more reason why you should not put your second set of books on the internet. Bad idea. Because it would really suck if someone found them and then put them on YouTube. I'm sorry, I still can't believe that happened. It's just, oh my god. Anyways, now that we know what's in the denominator, we can correct for this and calculate a more accurate version of Sunnova's O&M per solar system. First, batteries cost around 1/6 as much to maintain as a solar system, according to the pre-sale reports. So we simply take the least PPA and easy PPA customers plus 1/6 of the least storage customers, and that's our denominator. Then we take the total O&M and add in the payroll, and that's our numerator. Now, Sunnova's probably going to complain that I don't take out the net natural disaster losses and non-cash inventory and other impairments, but I mean, if that's not O&M related, why are you recording it in your O&M at all to begin with? Literally, I'm just saying that Sunnova's O&M per system is Sunnova's O&M per solar system. I only make two assumptions here, really. Assumption number one is that batteries cost as much proportionally in reality as they do in the pre-sale reports. And assumption number two is that Sunnova does not practice slavery. I think those are both reasonable assumptions, but Sunnova is free to disagree, if I suppose. And as you can see, once we untie this Gordian knot, it's pretty clear that Sunnova's O&M expenses are totally out of control. Their actual O&M per solar system, according to my analysis of the hidden data, is way higher than the reported O&M per system. Like in 2023, it's slightly more than quadrupled over the reported. Now, this is a problem because the reported O&M is very similar to what the pre-sales indicate Sunnova's being paid for servicing the systems and the securitizations. So that means the difference between the O&M as reported and the O&M as I just calculated it is roughly the difference between what Sunnova's being paid to do the O&M and what Sunnova is paying or spending on doing the O&M. I don't know about you, but to me, this looks like an O&M death spiral. Now, again, there is some noise in that data. The customers in the financials and the customers in the pre-sales are not a perfect comparison, but they should be close, but these numbers aren't close. They're nowhere near each other. And that indicates that Sunnova is making a huge loss on O&M. And what did Sunnova's then CFO Robert Lane say that would be?
We cannot generate a loss at O&M, and because then that would be fraud.
So I'm having a really hard time reconciling what I see in Sunnova's numbers with what Robert Lane said on tape would be fraud, because as far as I could tell, they seem to be the same thing. That just strikes me as something that's really strange, and I would love if Sunnova could tell me how to square that particular circle. Now, I'm not accusing Robert Lane of doing anything wrong here. All I'm saying is that he said on tape that if Sunnova was running a loss on O&M,
then that would be fraud.
And I'm also not saying that Robert Lane knew about the apparent O&M losses and the apparent cover-up of those O&M losses. All I'm saying is that he was the chief financial officer of Sunnova at the time this was happening. The second set of books appears to have been part of the cover-up, and if you go to the info tab of the file containing the second set of books, Robert Lane is the listed author of that file. That's all I'm saying. Make of that what you will. Now, I'm not going to name names here. Sunrun! Look at Sunrun! But I very, very heavily suspect that Sunnova is not the only residential solar company with a second set of books. They're just the only ones who screwed up and put theirs on the internet. Hold on, I gotta add this quick disclaimer. This is an unconfirmed suspicion I may personally hold about one or more other companies, which I am expressing purely as my own opinion. So if you're an analyst covering this industry and you happen to have access to the pre-sale reports, your logical next step is to crack open the pre-sale reports of the other companies and see if the O&M in those pre-sales is close to what Sunnova is getting in their pre-sales. Now, if you found a close match, I personally believe that would be suspicious enough to warrant further investigation by a savvy investor. And if you chose to further investigate the O&M numbers, and you have a Kroll report in front of you, you can find the O&M numbers pretty quickly by doing a Control-F word search for the words, quote, with storage. Because ever since batteries started getting included in the securitization, Kroll will basically always say O&M is such and such with storage and such without storage. And that's one of only a few places in the whole report where the words, quote, with storage, unquote, will appear. So, if you do the obvious thing and ask these companies, your O&M seems a bit low, Mr. Solar Company. How do we know your solar systems are actually worth what you say they are worth? And then they're gonna say, because independent appraisers say so. Now, you gotta remember that the residential solar companies pick and pay the appraisers, and personally, I don't really understand how you can call an appraiser independent if the appraiser works for you. So, of course, if you do the next logical thing and ask a residential solar company if you can see their appraisals, that company will probably react like you had just asked if you could kill their dog. It will be a very hard no. Now, they're gonna say they can't share this information because it's full of trade secrets and proprietary information or something like that, but think about this for a second. They're valuing a solar system. Solar systems are regularly sold on the free market for cash. determining the fair market value of these things should be pretty easy. Yeah, okay, maybe there's a little bit of wiggle room on the exact value, but I don't see how it's possible for their appraisals to be complicated enough for proprietary information and trade secrets to work their way in. Like, as far as I can tell, these companies are just claiming to have a secret and mysteriously valuable way to generate the numbers they send to the IRS, and this process is so valuable and secret they can't tell anyone about it, including the IRS, because the IRS doesn't check the appraisals either. And personally, that's always struck me as a bit of a red flag. And it's also really concerning because, based on my knowledge of how these companies are financed, it's really easy for these companies to turn into accounting schemes if their appraisals are overvaluing their solar systems. So considering that these appraisals seem to produce mysteriously valuable solar systems, and no one ever seems to check the appraisals, it just seems to me that this is the sort of thing that could lead to a really big systemic problem in the industry. So I'm just saying, if you work at the IRS or SEC or something like that, it might be worth, checking if the numbers in those appraisals are actually correct before, before you approve billions of dollars in tax credits based on them. Like, if you work at the IRS, let me ask you one question. If the appraisals were written in crayon, would you know? Like Crayola crayons. And I think we both know the answer to that question. Now, this is the end of the main body of the video. I have more videos on Sunnova coming out, so please subscribe and ring the bell if you don't want to miss them. Also, if you like and comment, the algorithm will promote this video and help get this information out there. But before we go, I promised to go on a little tangent explaining something earlier in this video. Okay, so why does inflating sponsor equity by $1.50 not mean you get an extra $1.50 when you sell the sponsor equity? One of the details I glossed over for sake of simplicity is that the partnership flips and the securitizations are not quite the same thing. Let's say a residential solar company claims to have $5 worth of solar systems, and they want to turn those assets into cash. The partnership flip comes first in the process, and this is basically where the residential solar company promises the tax equity guy $2 and promises the sponsor equity guy $3. The partnership flip has to come out at roughly 40-60. This is, of course, assuming that the ITC, the tax credit, is 30%. If it's not 30%, then it's not going to be a 40-60 split, it'll be a different split. Step 2 is the securitization. That's where you sell those promises, and the confusion you're experiencing is that a $3 promise is not necessarily worth $3. Here's an example you'll be familiar with. If a store sells you something on credit and you promise to pay $10 for it and then don't pay, the store might eventually give up and sell that $10 debt to a debt collector for, let's say $2, which actually probably be a bit high, but whatever, let's say it's $2. And the term for that is a haircut. The store took a haircut. Your $10 promise is only worth $2, but that doesn't change the fact that you still owe $10. When it comes to residential solar securitizations, you don't have to give the tax equity and sponsor equity the same haircut. If you overvalue the sponsor equity in the partnership flip and then give it a bigger haircut than the tax equity when you're selling the securitization, or technically it'd be securitizations because they both get their own but they're linked. The partnership flip comes out looking 40-60 when that's not really their true values. Now, if you're sitting there thinking, hey, wait, wouldn't that just be tax fraud? That's a question I had as well. And to be clear, I'm just trying to communicate a concept here through hypotheticals. We're talking about what would happen hypothetically if a hypothetical company hypothetically did this. But anyways, to make a long story short, basically a lot of the ways you can juice the sponsor equity the partnership flip doesn't really work their way into the final price the securitization is actually sold at. So to summarize a long story in plain English, the sketchier the numbers, the bigger the haircut you have to give the sponsor equity investors. So if you lie about the sponsor equity in the partnership flip and then go to sell it, you only wind up getting a very small piece of that lie back as cash from the sponsor equity investor. Instead, the whole reason you're doing this is to get the easy tax fraud money up front right now. This part is just to cover that up. Basically, a solar company that was engaged in this sort of scheme would be selling empty promises they can't fill at a big haircut in order to cover up a tax fraud, and being paid very little for it by the sponsor equity guy, but they still owe what they promised to the sponsor equity guy. Now you might think, wow, that sounds like a good deal for the sponsor equity guys, and that's why a lot of sponsor equity investors didn't look too closely at this. The detail the sponsor equity guys missed was that the solar companies had to put the tax equity at the top of the waterfall and sponsor equity at the bottom in order to convince the tax equity guys to go along with the scheme as well. So that means on paper, the sponsor equity will get entirely wiped out before the tax equity loses $1. So I would expect the sponsor equity guys to just wake up one day and discover their whole investment got nuked.